As Tony Robbins says in The Holy Grail of Investing, these individuals play the money game at the highest possible level. In this video, I'll show you an investment that pays you just like a hedge fund manager. You'll learn why 15% of the Forbes billionaires built their fortunes through asset management firms, and how you can get in the same investment structure through general partner ownership. If you're new to the channel, I'm Santiago. I'm a professional investment analyst, and I help high-income professionals learn to invest just like the top 1%. If you have never heard of the term general partner ownership, also known as GP stakes investing, don't worry, I'll explain this investment structure throughout this video. GP stakes investing is a structure that positions you on the same side of the table as the asset managers themselves by owning a minority stake in their firms. But how do you get access to buying a minority share of a hedge fund or asset management firm? It's not like you can just pick up the phone and call a hedge fund to buy a GP stake. This has existed almost exclusively for highly sophisticated investment firms, but opportunities currently exist for accredited investors to participate in GP stakes investing. The key is investing through what is called a GP stakes fund. This is a fund that itself buys minority stakes in successful private asset managers. Firms like Blue Owl and Kaz Investments operate in this exact way. They acquire minority equity positions, typically between 10 to 30%, and establish asset management companies. They become a silent partner of the firm. When you invest in such a fund, you become a fractional owner of the entire portfolio of the investment management businesses. Your returns are derived directly from the investment manager's success at the firm level instead of the investment fund level. It is the exact economic structure that creates billionaire hedge fund managers simply accessed through a fund-of-fund model. So I've taken a lot of time studying this subject, and when you study the wealthiest names on the Forbes list, a consistent pattern emerges. About 15% of them are involved in asset management. These asset managers are what is called a general partner, and you'll understand what this is. A general partner controls the asset management firm themselves. So think about Bill Ackman, Ray Dalio, Steve Cohen. Each one of these individuals is a general partner. When investors invest in a hedge fund or any type of private market fund, they become what is called a limited partner. So they are the investors that invest in the general partner's investment fund. The limited partnership is then managed by the hedge fund manager, who is the general partner. The general partner business model generates wealth through three distinct revenue streams that work together to create a compounding wealth machine that builds these billionaires their wealth. And let's walk through this. So the first revenue stream comes from the management fees. This is the 2% of assets under management. For a firm overseeing $1 billion, for example, that translates to approximately $20 million in annual revenue just in management fees. The management fee isn't performance-based, it's contracted income that provides a predictable cash flow just for the privilege to invest with the firm. The second stream of income comes from the balance sheet returns. The general partner usually co-invest alongside the limited partners in their own funds, and this allows them to earn returns directly from the fund's performance. And this makes sense. If you're starting an investment fund and you're investing for your limited partners, it makes sense that you would invest alongside of them with your own money. This creates alignment between the firm and its investors because the hedge fund manager's money is at stake as well. When we're looking at the general partner business structure, there's also a third revenue stream, and this is called the carried interest. This is the 20% performance fee on the investment profits above certain thresholds. So if that same billion-dollar fund doubles its money, the general partner receives $200 million in carried interest income. That's the bonus performance off that return. This performance-based compensation represents a significant wealth building component of the entire general partnership structure. Together, these three revenue streams form a highly profitable business model that generates recurring cash flow. The general partner investment model allows wealth to compound more quickly because of the diverse revenue streams, and you're not only relying on investment performance like the limited partners. This explains why hedge fund managers tend to have a heavy representation on the Forbes list. Instead of investing as a limited partner only, if you invested as a minority owner in the general partner, also known as GP stakes investing, you can share in the same economics and get paid just like a hedge fund manager. So let's take a moment to better understand the performance fee, also known as the carried interest, and how the economics play out between the general partner and the limited partner, and why it's so powerful to be on the general partner side. So carried interest represents the true wealth creation mechanism that creates all of these billionaires. So while the limited partners receive returns based solely on the investment's performance, if it goes up, you're good. If it goes down, not so good. General partners capture additional value through this performance-based incentive structure and the management fees. Most individual investors never get to participate in these economics. They remain on the limited partner side, receiving only their proportional share of investment gains and splitting it with the general partner without accessing the management fee structure. And I'll break down an example that looks a little bit like this. So let's say that you are a limited partner and the general partner returns you 20% returns on an original $1 million investment. So that would look like $200,000 in returns, but you would have already paid 2% in your original investment in management fees. So that's $20,000 every single year that's going to management fees no matter what. And then of the $200,000 profit, you would need to split it 80-20 with the general partner. So your final return ends up being $140,000 from the original $200,000 as the limited partner. So instead of investing in the funds as a limited partner, what if you invested directly in the management company as the minority owner? This is the GP stake side. The business entity that generates all the management fees and the carried interest and gets the balance sheet returns, you share in those profits just like a hedge fund manager on the same economics. When you own a minority stake in a general partnership, you become a part owner of all three revenue streams. You receive a proportional share of the 2% management fees that are contracted, a share of the balance sheet returns, and crucially, the most important part, a proportional share of the valuable 20% carried interest bonus. So this approach effectively mirrors the economic benefits that are enjoyed by hedge fund managers and private asset managers themselves, just on a smaller proportional scale based on your level of ownership percentage in the general partner's firm. This strategy generates what the industry professionals like to call GP alpha, and that stands for the excess return from owning the management company rather than just simply investing in the funds as a limited partner. And so while limited partners benefit from the investment performance, and there's nothing wrong with being a limited partner, GP stakes holders benefit from the investment performance plus the fees and also the carried interest by being a minority owner in the firm. The difference in the return potential becomes substantial over time, particularly if the manager of the firm is very successful and consistently attracts assets and generates strong return performance. Because the more assets they manage, the more contracted 2% fees that they can get, and the better they perform, the higher their carried interest. So now that you have a better understanding of GP stakes investing and how you can get paid just like a hedge fund manager, as I always say on this channel, I'm here to teach investors about the many strategies that exist outside of stocks and bonds. And never forget that these investments require a ton of due diligence, and the commitment is a long-term investment commitment. This is not a liquid investment that you can just sell in and out of owning a minority stake of a hedge fund. So always make sure you examine if this strategy is a proper fit for you and your situation and your goals. You typically will find investments like these through financial advisors that specialize in alternative investments, which is exactly what I do as a professional investment analyst. I help individual investors access top-tier investment strategies so that they can begin investing like the top 1% of investors. The GP minority ownership structure gives you a structure where you can put the odds on your side. And as Tony Robbins says, every success story leaves cues, and it's up to us to model those cues of what makes billionaire hedge fund managers so successful. GP stakes investing delivers the precise economic architecture that creates 15% of Forbes billionaires. So, if this breakdown helped you understand alternative investment structures, go ahead, leave in the comments what you would like to learn about next. And don't forget to subscribe to the channel so that I can keep creating content just like this. Also, don't forget to subscribe to my email list that's going to be linked in the description as well. And make sure you follow me on Instagram. That's also linked in the description below when you click the link, where I post insights about alternative investment strategies. So now that you know how to invest like a hedge fund manager, check out my video about how I spent 1,068 days trying to invest my own portfolio just like a hedge fund manager.